Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding Credit Risk, a comprehensive guide for businesses. Qualitative assessment. While quantitative methods are vital, qualitative factors also play a crucial role in assessing credit risk. These factors encompass a borrower's character, management quality, and economic context. Here are some key qualitative aspects to consider. Management experience. In business lending, the competencies of a management team can significantly affect the borrower's ability to navigate challenges and succeed. Industry conditions. Understanding the broader economic and industry context helps lenders gauge the risks associated with specific borrowers. Borrower behavior. Lenders should consider patterns in a borrower's communication, responsiveness, and overall reliability. Have they previously negotiated terms or communicated proactively during challenges? Reputation. A borrower's standing in the marketplace can indicate potential risks. A strong reputation often correlates with lower risk. Incorporating qualitative assessments provides a more comprehensive view of credit risk. By blending quantitative data with qualitative insights, lenders can make more balanced lending decisions. Are you ready to evaluate credit risk like a pro? Understanding these methods equips you with the knowledge to navigate the complexities of credit assessments efficiently. Credit risk management strategies. Managing credit risk is essential for any business aiming to maintain financial stability and mitigate potential losses. By implementing effective strategies, companies can navigate the complexities of credit risk and protect their assets. Here are some key approaches to consider. Diversification. Diversification is a well-known strategy utilized to reduce overall risk by spreading exposure across various borrowers, industries, or asset classes. By not putting all financial eggs in one basket, businesses can cushion themselves against potential defaults in any one sector. Portfolio spread. Balancing loans across different borrowers and industries helps minimize the impact if one area underperforms. Imagine it like a garden where diverse plants thrive together. If one type of plant suffers from disease, others can still flourish. Credit limits. Establishing limits on the amount lent to a single borrower or industry can prevent excessive concentration. For instance, if you lend too much to one client and they default, your losses could be significant. Spreading loans helps ensure that no single default can jeopardize your entire portfolio. Geographic diversification. Expanding lending across different regions can shield your business from local economic downturns. If one area's economy stumbles, others may remain steady, helping to balance your overall risk. By diversifying your risk exposure, you can enhance your resilience in the face of economic uncertainties, making your business less vulnerable to individual defaults. Credit derivatives. Credit derivatives, such as credit default swaps, CDs, are financial instruments used to manage credit risk more actively. They allow businesses to transfer risk to other parties, providing a layer of protection against potential defaults. Risk transfer. When you purchase a CDs, you essentially shift the risk of default to another entity. If the borrower defaults, the CDs seller compensates you for the loss. This is like getting insurance on a valuable asset. You pay a premium to protect yourself against significant losses. Hedging. Businesses can use credit derivatives to hedge against exposure to bad credit. If you know a borrower is at risk, a CDs can act as a safeguard, helping you manage potential fallout. Market indications. Monitoring the pricing of credit derivatives can provide insight into market perceptions of credit risk. A spike in CDs prices on a specific company, for example, often indicates growing concern about their creditworthiness. While credit derivatives can be complex, they offer strategic options for managing credit risk and can play a critical role in a well-rounded risk management toolkit. Establishing credit policies. Having robust credit policies is foundational for any effective credit risk management strategy. These guidelines set clear standards for assessing, approving, and monitoring creditworthiness. Assessment criteria. Define specific criteria for evaluating loan applications, including credit scoring thresholds, income levels, and collateral requirements. By adhering to strict standards, you minimize the chances of lending to high-risk borrowers. Approval processes. Implement a clear approval workflow that involves multiple levels of scrutiny. Consider requiring different team members to review applications, which adds a layer of oversight and helps catch potential issues. Ongoing monitoring. Regularly review borrower performance and market conditions. If a borrower shows signs of financial strain, early detection can help you take action to mitigate risks promptly. This means keeping an eye on payment histories and remaining attentive to economic signals. Policy review. Continually revisit your credit policies to ensure they remain effective amidst changing market dynamics. Adjustments may be necessary based on new lending trends or economic shifts. By establishing comprehensive credit policies, businesses can not only protect their financial interests but also cultivate a culture of diligence and responsibility. Are your credit policies up to par? Examining and enhancing them can be a game changer for managing credit risk effectively. Impact of credit risk on financial institutions. Understanding credit risk is vital for financial institutions. It affects everything from capital requirements to overall profitability. Addressing credit risk properly can determine a bank's stability and growth potential. Let's break down 2 key ways credit risk influences financial institutions. Risk-based capital requirements. Financial institutions operate under strict regulatory frameworks that dictate how much capital they must hold against potential losses from credit risk. These are called risk-based capital requirements. Essentially, these regulations ensure that banks have enough cushion to absorb losses, protecting both the institution and the broader financial system. Minimum capital ratios. Regulations, like the Basel III framework, set minimum capital ratios, which determine how much of a bank's assets must be funded by equity. Higher risk exposures require more capital. If a bank lends to riskier borrowers, it needs to hold more capital in reserve. This is similar to having a wider safety net if you're walking a tightrope. More risk means you need more balance. Risk weighting of assets. Different types of assets have varying risk weights according to regulatory guidelines. For instance, loans to high-risk businesses or individuals might carry heavier risk weights. This means that a bank must hold more capital against those loans compared to safer assets, such as government bonds. Stress testing. Regulators often require banks to conduct stress tests. These tests simulate tough financial scenarios to assess whether banks can maintain adequate capital levels under stress. If a bank consistently fails these tests, it may face restrictions on dividends or further lending, limiting its growth. By following these requirements, financial institutions ensure they're prepared to manage credit risk effectively. How well they navigate these rules can dictate their long-term success. Loan loss provisions. Credit risk significantly impacts how banks manage loan loss provisions and reserves. Loan loss provisions are funds set aside to cover potential losses from loans that may default. Understanding how credit risk influences these provisions is crucial for financial reporting and long-term viability. Assessing default probability. Banks must regularly evaluate the likelihood that borrowers will default. This involves analyzing historical data, credit scores, and economic conditions. A higher perceived risk leads to increased provisions. Think of this as preparing for a storm. If the forecast is bleak, you're going to stock up on supplies. Impact on profitability. Increased loan loss provisions directly affect a bank's bottom line. When provisions rise, net income falls. For instance, if a bank sets aside more money for potential losses, that's capital they can't use for lending or investing. This reduces profits and can impact shareholder returns. Regulatory scrutiny. Regulators closely monitor loan loss provisions. If a bank consistently fails to allocate adequate provisions, it may face scrutiny or penalties. On the other hand, over-provisioning can hinder growth, signaling a lack of confidence in its borrowers. Finding that balance is critical for banks to maintain credibility and operational efficiency. In summary, credit risk shapes the operational landscape of financial institutions. By understanding and managing these impacts, banks can enhance their stability and support sustainable growth strategies. Are your credit practices aligned with the challenges at hand? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.